Yep.
Okay. All right. Well, thanks to everybody for coming. I'm glad to have today with us Bill Ziemba, who will be talking about a wide range of topics on from his long career in finance and gambling and various other risk related fields. He's worked in academia for a number of years, written quite a few papers, quite a few books, some of which I have a few copies of laying around, although not on me at the moment. And um, he's done so many things that he's going to try to talk about almost all of it today, I think.
Not,
So we're going to go.
not quite, my friend.
We're
But
going to go through. We're going to go through a few different topics, and so just wanted to thank Bill for being here, and we can get started in a minute here once I can find the right window to share. So let's go ahead. So whenever you're ready.
that's good. Now, thank you, Harry. So, what I do, or I try to do, is to combine theory and practice, and the practice helps the theory, and the theory helps the practice. So, Harry, can you hear me?
Yes.
Okay. Can you see something if I show something? Can you see this?
If you hold it up a little higher.
Okay. Now, the first two papers on Kelly investing are reprinted in this book, Great Investment Ideas. I'd like to tell you that I also have other things in the book that you might find interesting to get it. And what the book does is there's two papers on how to evaluate the greatest investors, and then there's lots of other papers of different things, and they all tend to be sort of a quantitative analysis of interesting problems. Like, for example, one chapter is on 60-40 investing in the stock market. Now, I was a consultant for many years for the Frank Russell Company in Tacoma, Washington, the top pension fund people in the US. And they pushed 60-40. And what I discovered in terms of research, initially with Chris Hensel and later by myself, was that there's a huge presidential effect. So when you have a Democrat in the White House, the small caps greatly outperform. Anyway, the net result is that a strategy where you go long small caps during Democrats like Biden, and it's worked really strong this year. Uh, and with a Republican, you go long bonds or large cap S&P 500. Anyway, the presidential strategy gives you 20 times more money in the end than the strategy of 60-40, which Frank Russell is pushing to their clients. And the reasons for it are clear. When stocks fall, bonds tend to rise. So anyway, I just want to entice you to look at more papers in this book. There's a few other good ones in there that I enjoy a lot. So Harry, I can do the paper now.
Okay. There you go.
Okay. Now, I enjoyed a lot working with Thorpe. He is basically, there's only one way to describe him, a genius, very, very talented person. And he was the first one to really push Kelly investing. And he did it in his blackjack work around 1960. Now, we pushed Kelly investing in our racetrack work, which started with the first paper in 1981 in Journal of Management Science. So what this does is it gives you a bit of a tour through it by looking at simulations as we do. So if I look at the first thing, first of all, if you look at the abstract, it talks about Poundstone's book, which is very nice. It popularized it. The only problem with it is he doesn't understand how to calculate it in the case when it's more than one investment. We have a handy formula for the one investment case, which is the edge over the odds. And that's a formula that works for the one-dimensional case, but only that once. Now, full Kelly is the maximization of expected log. Fractional Kelly blends that with cash and is closely related to negative power utility. Now, what do we learn in the simulations? Over long horizons, could you go back to the first page, please? Here, over long horizons, Kelly is greatly superior. Okay. In a short-term performance of the Kelly is very risky. The reason for that is that the Arrow-Pratt risk aversion index is equal to 1 over W for log, which is essentially 0. So essentially 0 risk aversion. So log is your most risky utility function you ever want to use. You never want to be any more risky than log. And so therefore, short term, it's going to have violent moves. Now, a lot of people use it. My 3 leading examples are Warren Buffett, George Soros, and Maynard Keynes, who you all know have great records. Now, it's not clear that they understood the mathematics of it, but they actually do it the way it's so forth. Now, there is a trade-off of growth versus security as a function of the bet size. Now, here's a key one. No matter how favorable the investment opportunities are or how long the horizon is, a sequence of bad scenarios can lead to poor wealth with a loss of most of investors' capital. This is crucial for the Samuelson comments that we're going to talk about later. Carrie, can I go to the next page? Now, this all starts with Bernoulli, 1738. And what Bernoulli did was he said that marginal utility is over time, first of all, it's concave, so forth. And then the question is, how does it slow down? So what he assumed was that the marginal utility slowed down by 1 over W, so forth. And if you do that, you immediately integrate that and you get log. Okay. Now, Kelly did the original paper that's widely cited. And in the Kelly paper, he has a very, very simple case, which is on the bottom of this page. We will do it in a minute. And he did that. Latané did economics arguments that log utility was equivalent as well. Bryman, who was at Berkeley, showed that the procedure had good long run properties, and it maximizes the asymptotic long run growth rate almost surely, and it minimizes the time to achieve asymptotically large goals. So that's a very good paper. We tried to put Thorpe and I in our handbook called the Handbook. I've got it here. Here. There's this handbook of the Kellyapple criteria. What Thorpe and I did with Len is we tried to get all the best papers of the theory and put them in here. So it's mostly theory, but some practice. But I think we have most of the major papers reprinted in here. Now, the simplest case, this is very, very nice. The asymptotic rate of asset growth is G equal to the limit of the log of the final wealth over the initial wealth to the 1 over n power. Okay. Then you consider Bernoulli trials, win one or lose one with certain probability. Then you have the wealth at n trials. It's the number of winners times the losers times the initial start. So if you then plug that in, plug that in, and then if you go to the next page, please, you will find that you get G of F is equal to P log 1 plus F plus Q log 1 minus F equals E log. So you automatically get that. So notice what it does. It takes a multi-period situation over time and changes it into a one-period optimization. Okay, so that's what you get. Okay, so now how much do you bet? Well, in the next paragraph here, you have the edge and the odds. And so the optimal Kelly bet is listed there. Little f star equals the edge over the odds. So for example, if your edge is 10% and your odds are 1 to 1, you bet 10%. If your edge is 20% and your odds are 10 to 1, you bet 2%. So it's a very handy formula for the one-dimensional case. However, to calculate for multiple assets, you need to solve a small stochastic program. Okay, now the bets can be very large. So here's a one. If the probability of winning is 99 and losing is 0.1, the optimal bet is 98%. Now, Warren Buffett gives a lunch every year, and a hedge fund guy called Monish Pirabai spent $600,000. He had a particular investment. Over a 24-month period with probably 0.8, the investment at least doubles. With 0.9 probability, the price even, and with 0.1 probability, you lose the investment, all of it. The optimal Kelly bet is 97.5 of wealth. Half Kelly is half as much, 38. What did Faraday do? He invested 10% in the real world, which seems possible. However, you can argue that short-run losses, bad scenarios, price pressures, buying in and out suggest you might be a bit lower. So that's that sort of idea. Now, here's the Arrow-Pratt index, and you see it's 1 over W, essentially 0. So therefore, it's risky. Next slide, please. Now, Chopra and myself looked at errors, and I'm going to show you a picture in the other lecture of errors in means, variances, and covariances in portfolio problems. What we showed was that the errors are 20 times more important for the mean, 10 times for the variance on average. But for log utility with low risk aversion, this is more like 100 to 3 to 1. The actual Chopra Ziemba paper is in that first book, Great Investment Ideas, if you want to read it. Very important for actual practice. Now, log utility is related to negative power utility when alpha goes to 0. Okay. Now, we use the handy formula F equals to 1 over 1 minus alpha is optimal when the asset returns are log normal. Here, the Kelly strategy is F times the fractional. Now, this approximation can be poor if the assets are far from log normal. So if you want to use the negative power approximation, it's better to be close to log normal assets. Okay, now I study a lot disasters in the stock market, and betting more than the Kelly amount leads to lower growth and more risk, and it leads to disasters. I did a book with my daughter, and that's on simulations for Wiley. But a better reference for this is in the Handbook of Futures, which is basically, I try to get all the books paperback so they're not expensive. But in the Handbook of Futures, we discussed all these overbet disasters, long-term capital, Niederhofer, Amarath, and a bunch more. And we had GME this year as well, and so forth. Now, in continuous time, very interesting formula, the long-term growth rate, G star, is equal to half the Sharpe ratio squared, plus the risk-free assets. Very interesting formula. Okay. Now, I'm going to skip the stuff below about discretionary wealth. A fellow called Wilcox in Boston has written a couple papers on that, and that deals with taking your assets and saying some of it is for investing and some is for consumption later. But if you're interested in that, you can do that. Leads to a fractional Kelly strategy. Can I go to the next page? Now, we've written a couple papers on the good and bad properties of the Kelly, and you'll find them in the big book, the Handbook, as well. And I want to tell you an experiment. If you go to the bottom of the page, here it is. Now, just think of the following: there's a jar with colored balls in it, and there's 5 colors plus a black one. So there's red, yellow, green, blue, and purple. So you pick out of the jar one of these balls, and that is the wager that you do. Now, in our racetrack books, we always recommended for normal investing, don't invest unless the expected value is 1.14 or higher. That compensates for the errors that could be in the approximation. So I have 5 wagers. They all have expected value 14% advantage. Now I'm going to have 700 of these. Okay. So I'm going to do 700 decisions, and then I'm going to have 1,000 scenarios. And then I'm going to compare 3/4 Kelly, half Kelly, full Kelly, 1/4 Kelly, and 1/8. So we go to the next page. So for the top is the probabilities. So for example, they all have expected value 0.14 advantage. So if it's an even money bet 1-to-1, you want the win probability of 57. If it's 2-to-1, 38%, so forth. Now, since the optimal Kelly bet is the edge over the odds, you get lower bets in the ones with longer odds. You see the 0.028 there with 5-to-1. So now the question is, I do 700 bets when I have an advantage in every single one of them. And guess what? If I have a minimum return, it's 4. And that took 1,000 and turned it into 4. In other words, you lost essentially all your money. Okay, and that's when you have 700 independent bets. They each have a 14% advantage, and they have a fairly high chance of occurring favorably as well, as you see, 57% probability of winning. Okay, so the first thing we learn is no matter how good the bets are, it is possible to still lose a lot of money with bad scenarios. And this is at the heart of the Samuelson critique as well, or at least my response to his critique. And then the table. We did several of these calculations with different number of scenarios, and they have different amounts. So if I go to the next page. So here are the pictures. With full Kelly, you go along, and then you do so forth. These are the highest wealth ones. Remember, we're doing simulations. We have lots of scenarios, and this is the scenario that actually had you the best result. There's 700 of these bets. Make 700 bets. Notice that with half Kelly, it turned out that you made most of the gain right at the buzzer, and the others were kind of a little more linear. So now if I go to the next page, Harry, this will show us the worst outcomes. So in the worst outcomes, with full Kelly, you're finished at 300 bets, 400 bets in the first one. The half Kelly goes all the way to 700, as do the others. And you see they dribble down. So in terms of the simulation, we have the best one, we have the worst one, we have the median, etc. I did it a little bit fast, but if you go back and look, the median return is high, and the actually highest ones are astronomical amounts of money. You make a huge amount of money, etc. But it's possible to lose. Can I go to the next page, please? Now, I'm gonna watch my time here. And we have a few more experiments we did. I just want to briefly mention them. The first one, the so-called Ziemba and Haas model, that's the one we did. This is just talking about it with different amounts of simulations. Can I go to the next? And you'll see here, there's different simulations. Sometimes we use 3,000 scenarios, and sometimes we do so forth. So we have different of the 5 balls that we're picking out as well. And if you look at the bottom table, you have the maximum, which is 503, 50,364, and the median is 17, and the minimum was 42 with that simulation. But you get the same kind of idea. The idea is that most of the time, the full Kelly gives you enormous wealth. Some of the time, you have bad scenarios and you do poorly. Can I have the next slide, please? I'm going to go to the next page here. These are just simulations of returns, minimum and maximums. Can I go to the next? Same thing as well, log wealth. Bixler and Thorpe had an example where they have one risky asset with a mean return. And you can borrow or lend capital at a certain rate. Now, the only thing is, as Warren Buffett would tell you, when you borrow money and lever, you can lose a lot of money, and so forth. So that's what this example is supposed to show, and it does. So if you go to the next slide. You calculate the investment proportions with so many decision periods. And they'll calculate the distribution of final wealth. And then we have some formulas at the bottom. I'm going to go to the next page and so forth. So here's the conclusions. The statistics deriving end of horizon wealth are monotone in the fraction. Minimum wealth, growth and decay are much more pronounced. And so forth. Excuse me. The maximum and minimum final wealth trajectories show the wealth growth and the risk of strategies. Can I have next, please? Okay, so here's the different types of fractional Kelly. And here we have the maximum and the minimum returns. Could I have the next slide, please? Inverse cumulatives of normal distributions. The next slide. Then Bixler and Thorpe. Bixler, by the way, is from Rutgers, if some of you don't know who he is. In the third experiment, there are two assets, US equities and US T-bills. Jeremy Siegel of Wharton writes a lot of books on the returns of US assets. The 02 is not the latest. There's recent ones all the time. But more or less, for a long period of time, US equities returned about 10%, so far. So the Kelly strategy is to invest a portion of wealth in equity, sell short the T-bills. And the question is, will there be a chance of substantial losses? Bixler and Sharpe uses 10 and 20-year decision periods, 50 scenarios. We use more decision periods and more scenarios. And the results are on the next page. If I go to the next page, please. In the most aggressive strategy, it is possible to lose 10,000 times the initial wealth. This assumes that the short selling is permissible, so forth. So what I'd like to argue to you is the Kelly strategy is terrifically interesting for lots of cases, but if it's misused or used leverage, you can lose a lot of money and go bankrupt as well. I'm sorry, I'm trying to get through in terms of watching my time. And I quote the next slide, please. The next one. And the next one. And I'm going to go again to the end. Final comments. The wealth accumulated from the full Kelly strategy does not stochastically dominate fractional Kelly. The downside is often more favorable with a fraction less than 1. So full Kelly does not stochastically dominate fractional Kelly. There's a trade-off of risk and return. In cases of large uncertainty, either from volatility or estimation error, security is gained by reducing the Kelly fraction. The full Kelly can be highly levered. With the use of borrowing can be effective in generating large returns on investment. Increased leverage beyond the full Kelly is never warranted as it is growth security dominated. You never want to bet more than full Kelly. The Kelly strategy is not merely a long-term approach. We did do a couple papers listed here, Zhao and Ziemba and McLean, Zhao and Ziemba. What we do is we try to reduce the Kelly fraction to stay above a path with high probability, which is quite a good thing to do because it's a very good way to run a business, to stay above a path. Now, the next paper is I'm going to do so forth. Now, I hope if you have any questions, by the way, just ask them. Now, Paul Samuelson was an interesting character. When he was in the late 30s, he was a junior fellow at Harvard. And in the 3 years of the fellowship, he wrote 25 papers in the best journals, enough to become a full professor at Berkeley or Chicago or Stanford. But he wanted to go to stay at Harvard as an assistant professor. But because he was Jewish, they would not hire him. So unfortunately, when people are discriminated against in this manner, it affects them their whole life. So Paul always had a kind of a side to him that was critical. And he would get into battles with different people like Milton Friedman and with Thorpe. So I have to tell you the Thorpe one. Now, Samuelson was searching for the so-called Black-Scholes formula for pricing options. As you may know, Black and Scholes did their paper and it was rejected by 4 journals. And finally, my dear friend Merton Miller and Eugene Fama, who you've all heard of, got and put the paper in a Chicago journal of political economy at that time. So it was not well accepted, but they got it published. And of course, they won the Nobel Prize later with Bob Merton, who derived the Black-Scholes formula using the Ito calculus, a much more mathematically sophisticated approach. So Samuelson was searching for this formula, but he couldn't find it. And he did at the end get a good student to work with him. In fact, Merton applied. Merton was in some type of quantitative undergrad, and he applied to 30 graduate schools in economics, was rejected at 29, and then was accepted by Paul Samuelson. And he was the smoking gun that Samuelson needed to find the Black-Scholes formula. But this was later than 1973. So let's bring in Thorpe. Thorpe in 66, 7 full years earlier, wrote a book called Beat the Market. And he was doing warrant pricing. And he had an approximation to the Black-Scholes formula, but he did not have the analytic solution. He had a numerical approximation, but he was doing it with real money successfully. And the answers that he was getting are within epsilon of the actual optimal if you apply the Black-Scholes formula. So Thorpe should have won the Nobel Prize for options along with Black and Scholes. But he made a crucial mistake. He wrote in his book, Paul Samuelson is searching for the optimal pricing of options, and I will show him how to do it if he reads page 72 of the book, of this book. So Samuelson, with his big ego, wanting to figure out everything, because he was essentially figuring out everything in economics. You know, that's why he's so famous. Really took it back by this. He didn't like this fact. So he unfortunately hated Thorpe for 40 years. And in fact, he hated him so much that for rational or irrational reasons, that in one of the 3 letters that he wrote to me that got me to write this paper, he actually referred to Thorpe as Jim, Thorp with an E, who of course is the 1912 greatest athlete of the century as well, instead of my colleague, etc. So Thorpe told me this story, and unfortunately he didn't get the Nobel Prize, but we think he deserved it. So what happens is Samuelson was very friendly to me. He was in my initial book, Stochastic Optimization Models in Finance, with some papers, and he was in things. And he would write me letters about different things. Like when I went to Japan, he wrote me letters about Japan and so forth. And then he wrote me 3 letters about Kelly, which I was very flattered that he would do that. So can I go to his objections? Can I go to the next page, please? Okay. Now I'm going to go to the 4 so-called objections. And if you look at the very bottom of this page, it says, I first describe Samuelson's objectives one by one in general terms, and then what I try to respond to them is I got some help from the research of Thorpe, Leuenberger of Stanford, and Harry Markowitz, all of whom agree with me in this debate with the deceased giant thinker. Then I described 3 investors Samuelson posed to me in the letters, with the addition of 2 tail investors that allow us to study risk aversion effects on the addition on portfolio choice. Okay, so that's thing. So if I go to the next page, please. Objection 1. The Kelly strategy do not maximize expected utility for utility functions other than log. Well, it's kind of obvious, right? If it maximizes it for log, that doesn't mean it's going to maximize it for other utility functions. And in fact, that's correct. And there really is no controversy here. E-log maximizes log return, log utility. And no utility function can maximize expected utility for other ones. Now, there is a Thorpe and Whitley paper in 1972 show that for different concave utility functions, you get different optimal decisions. So you line up 2 different concave utility functions, they give you different decisions. Now, Samuelson seemed to imply that the Kelly proponents thought that Kelly strategy maximizes, but this was never argued or implied. It is true that the expected value of wealth is higher with the Kelly strategy, but bad outcomes with low final wealth are possible. Now, Mike Stutzer, who works in these subjects, he's a professor at Boulder, Colorado, I think Samuelson was referring to a claim or conjecture in the Latine article. So the real problem is that some of Samuelson's critique were misused by later readers to falsely tar other non-problematic growth results in that and other papers. Okay. Well, in the letters he sent to me, he said that half Kelly explains the data better. Now, we never quite got the full explanation of that, but what it is half Kelly gives you a lot less growth, but a lot more security. So maybe that's what was in the back of his mind as well.
Bill, if I could ask a quick question.
Of course.
Yeah. So on the topic of half Kelly, this comment here, is this when he says it explains the data better? Is that a statement, an empirical statement, or is that a theoretical?
We don't know. And I think what it was is I don't know how you would even do it empirically. I think what he's really in the back of his mind is that for risky situations, half Kelly is probably better to use from a practical point of view. Now, you have to understand with Samuelson, he has also 2 types of out of his mouth. You know that he was very critical of certain types of investing. He was essentially a big proponent of efficient markets, which we will talk about later. And he was also a big proponent of the fact that there were superior investors, but you can't figure out who they are as well. But see, I'm very interested in stock market anomalies. I don't think Samuelson really liked them too much. He was more efficient markets, but he still had students who were working on anomalies, and they formed a corporation in Princeton called the Commodity Corporation, of which he was a part owner. So he tends to say one thing but believe in something else. Now, objection 2. Despite the fact that in the long run, E-log investors asymptotically dominate all other utility functions, it does not follow that an E-log investor will have good performance. Indeed, no matter how long the investment sequence is and how favorable the investment situations are, it's possible to lose a lot of money. And that is exactly explained by our experiment with the 5 balls. So you take good returns and lots of plays, and you can still lose a lot of money. Now, next page, please. Samuelson says, in no run, however long, does Kelly rule affect a dominating retirement nest egg. Of course, that's true. No matter how long you play, it's not true that you're always better. And then I have my example. We don't have to do that because we already did it, because we'll go to the next page. And we'll continue there, continue on the next page. Next page, please, Terry, thank you. And we've seen this before, just to repeat. And it's repeat, next page. Now, there are at least three approaches for dynamic investment that one could consider as stated. Now, this is a very nice Leuenberger paper in 1993 that was in the, a control journal. E-log W, we're talking about. Maximize expected utility for concave that's not log. Number 3, use consumption over time and weight it with a discount factor. So you have a discount factor beta, and when you're doing consumption over time of wealth. And Samuelson, in one of his articles, 69, which I have in my book, the 1975 and 2008 Stochastic Models in Finance. That paper is in there. Okay, many and great investors use full Kelly, E-log W, or fractional Kelly successfully, but this does not mean they'll have optimal policies for the second and third approaches, or will have positive gains. E-log betting can yield substantial losses, et cetera, et cetera. So the Kelly strategy maximizes the asymptotic long-run rate of resident growth. And I agree with Samuelson that this is a Bryman property. Next page, please. Objection 3. The Kelly strategy always leads to more wealth than any essentially different strategy. We know from the simulation that's not true. Okay, so Leuenberger has some stuff on this. And he investigates investors who are interested in the tail returns in the independent, identically distributed return case. And what he shows is that E-log W is optimal, simple utility functions, in a simple utility function case. But when you have compound utility functions, you have a mean variance kind of trade, Markowitz kind of trade-off, E-log W, variance log W trade-off is optimal, which he shows. Okay. Okay. Now, Samuelson 1970, also in my 75 and 2008 books, showed that it was an accurate log mean approximation to concave terminal wealth if uncertainty is small and the distributions are what are called compact. Jim Olson, one of my colleagues from Berkeley, wrote another paper that I put in the book as well. So this is a way of having that approximation. Objection 4 was an attack on my dear friend Nils Hackinson, who was in Berkeley and wrote a lot of papers on Kelly investing. He didn't really think of it as Kelly. He thought of it as capital growth. Now, Nils was a pretty bright guy, but the math is a bit subtle, and he had a couple errors. And Merton, of course, was a proper mathematician and pointed out these errors. And in the Merton Samuelson 74 in JFE, they pointed out errors in Hackinson, and they mostly have to do with the concept of almost always in the definitions. Now, I'm going to skip the the Leuenberger stuff. It's on the next couple pages if you like. It's technically very, very good, but not relevant for real applications. Now, Markowitz, though, has something very nice on this page. Let's see. Oh, I think it's back. Harry, can you go back? I think here's Markowitz. Here's Markowitz in his 76 and 2006. Simple utility function case. IID investments. With probability 1, there comes a time that forever after that, the wealth of the investor who rebalances portfolio P exceeds that investor who balances to Q. P is the expected log utility, and Q is an essentially different utility function, which means that it differs on infinitely often case. You can have the same returns for 1,000 plays, and then the next infinite are different. So forth. So basically, you can say a little bit about the fact that the log will basically tend to eventually dominate, but it's not perfect. Okay. But this does not imply that any particular investor with a finite life and consumption needs should invest in E log rather than Q. But it seems an unobjectionable use of the language to summarize the portfolio does better. Okay. And that's that. Can I go to the next page, please? Markowitz also, I learned that betting more than full K was dominated from the 1992 paper we did in Management Science on fractional Kelly. It's McLean, Ziemba, Blanzenko. And we were looking at trade-offs of growth versus security. And Markowitz, of course, is a very smart guy. He figured this out as well. And that he knew that betting more than Kelly is dominated. You never bet more than Kelly, so forth. And this is his wording if you read it here. Perhaps this is sufficient caveat to attach to the observation that the cautious investor should not select a mean variance efficient portfolio higher in the frontier than the point where the expected log is there, for a point higher on the frontier, subject to investor to greater volatility short run, and almost surely no greater rate of growth. Harry showed that if you approximate the mean variance model, the limiting one is log. Can I go to the next? I think we're just about done this paper. Here's my picture. Can we look at this picture here for a sec? Thank you, Harry. Perfect. Now, I don't know if you can see my thing. So here's the growth rate versus amount that you invest. Notice that when you're on this left side, the growth rate is falling, but the probability that you succeed is rising. So you have this growth security trade-off. Notice this is an experiment where you double your fortune before you have it. So you start with 100 and probably you get to 200 before you get to 50, or quadruple. Now, let's get to the top of the hill. That's the Kelly, optimal Kelly is the top of the hill. Now, what about if we go to the right? Well, the growth rate falls and the security falls. So you definitely don't want to do that. It just makes no sense. Harry, I'm done this paper. I hope that it's sort of clear on the ideas. And final, I'm sorry, I'm not quite done. There's the Samuelson investors. I have to do this. Okay, what Samuelson does in his Samuelson investors, he has a person with a power utility function. That's called Tom, W to the half. Tom, we're going to find, is going to go bankrupt. He bets too much. Dick is the geometric mean Kelly guy. And Harry is a half Kelly optimizer. But we have to assume that Harriet is smart enough to know that she needs log normal distributions to be correct. Okay. Now, I added in my write-up of this, IDA. Now, IDA has a utility function -1/n. Okay. Now, Ida is a real person who was the first person to ever receive a Social Security check in the United States. Ida put in $24 and lived to be 100 and received more than $1,000. And Victor is Victor Niederhofer, who is linear utility, and he's really, really risky, and he's going to go bankrupt too. So can we go to the next page? Okay. Well, I just have a table of the risk aversions of the different parties here, and that's in the table as well, and so forth. So we have the different risk aversions. Ida is Ida Mae Fuller of Ludlow, Vermont, who had Social Security 001 in 1940. She paid $24.75 and collected $22,889. Good for Ida. And then Victor goes bankrupt. And that's Victor Niederhofer, who was a pretty good investor until he overbet. It's, by the way, I can tell you, since I'm an investor myself, and once in a while I get into trouble as well, it's easy to get into trouble of overbetting as well. So the references on this, you can look up the Ziemba and Ziemba Wiley book if you want, or you can look up the Handbook of Futures. We have a paper in there. So Samuelson has a couple of tests. If you must invest all of your money in one option, who do you pick? And the answer is stocks. Dick is indifferent. Harriet goes to cash. Given a horizon with end periods and a final date of your retirement with a change. The blending problem case. Sorry, I have a bit of a cold. We're going to maximize, you get 4 times your money or 1/4 with certain probabilities. Can I go to the next slide? Next slide, please. Okay. When Dick Harries replaces so forth, she can be equivalent to having throwing away a defined portion of her initial wealth. What is left invested the proper way will fall short of what you can do as well. Can these one period harms erode away Tom and Harry and so forth? In a dual, I'm sort of a little bit doing this too fast. I'm sorry, I apologize. But anyway, in Samuelson's words, he does give McLean and I credit for our paper. Probabilities of growth rate do this when it's finite. Calculate is shown in Exhibit 5. So what we did in the paper was to try to be above paths in dynamic time and looking at the fractional Kellys. Okay. I'm sorry I'm a little bit fast on this. If you're interested, read it. It's kind of cute as well. But the basic bottom line is the power utility guy goes bankrupt. Victor goes bankrupt. The Ida is safe. She doesn't bet anything. And the Kelly guy has pretty good results. Now, select applications. Can I go to the next place? What I've got here is a table of historical stuff. Thorpe had the first use of the Kelly criteria in his blackjack work. I used it in playing the January effect in the stock market, which I'll talk about later today. And I used it in horse racing. And I used it in unpopular numbers in lotto games and horse racing. So now why do we use that in some of these applications? One is Kelly useful. It's when you have a repeated situation where you get many similar bets over time that are very similar, and you have a lot of them, essentially an infinite amount of them. So blackjack, you can play forever. Horse racing, you can play forever. Lotteries, you can play, and so forth. Now, the bottom graph is wealth histories for the places, our place and show system for the Kentucky Derby, 1934 to 2005. And notice that, first of all, the graph at the bottom is playing the favorite. And if you play the favorite, you go bankrupt. The top graph is the full Kelly strategy using our system on the Kentucky Derbies. And you can see that it gives you the most wealth, it's the highest, but it's pretty violent, ups and down. And the graph in the middle is the half Kelly. Notice that it's less risky, but it gives you less money in the end. Okay, can I go to the next page, please?
Could you answer a question about horse racing? How do you decide what your favorable bets are for the Kentucky Derby?
Well, can I do that in the next lecture, please?
Thank you.
I'm gonna.
Glenn, the next paper here, we'll talk about.
Yeah. Okay, so to partially answer the question, here is a look at the graph, the formula here. I have the probability of an I, J, K finish. I is first, J is second, K is third. So there's a whole N I's, and if I comes first, he can't come second. And if J comes second, he can't come third. So that's the summations. Here are the probabilities: Q1, QJ, QK. And we use this formula, it's like Bayes' formula. It's actually called the Harville Formulas. Now, in the Harville Formulas, the probability that I wins the race and J is second is the probability that I wins times the probability that J wins a race that does not contain I. So that's essentially Bayes' formula. Now, this is essentially a good formula, but I'm going to show you in the horse racing paper that in reality, it's not 100% accurate. The reason is when horses that are favorites do not win, the probability they come second or third is lower than the formula says. So we have a way of correcting this formula. So that's called discounted Harville. And we essentially put coefficients to the powers and readjust these probabilities. So that's that. We'll talk more about that. Now, what's in the constraint first? The constraint is I have so much wealth, W0, and I'm going to bet so much for place on horses and so much for show. Place is first or second. Show is first, second, or third. So what's inside the all the stuff at the top? Well, we're going to make the assumption that we're the last better. There's all these people make bets, and then we make our bet right at the last second. Okay, so what it is we're the little P's and the little S's. And the people in the crowd are the capital P's and the capital S's. So if you look at the second line, you have P over P plus capital P. That's for I and for J. So we are winning a place bet if I and J are first and second. So we want to add both of them. So then that's the fraction of the money that we have. We're trying to do the optimization out of the total. The total is the other people plus us. And the top part is how much we collect if I is first and J is second. So what that is the total amount of money, but then the way the payoff works is you pay off all the people their initial investment, and then they get a percent of the profits. Okay, so that's the formula there. So what did Hosh and I do in our book? We solved hundreds of thousands of these optimizations, and then we got a cute formula to approximate this so it was easy to do in practice. Okay, so I'm going to show you that in the next paper as well. You're actually only going to have to look at 4 numbers, and that'll determine if the bet is good enough, and then how much is the Kelly bet. Remember, we're doing Kelly optimization here. Notice this is full Kelly. Log. Full Kelly. And we have the effect of transactions costs. So we are changing the odds based on how much we are betting compared to everybody else. We use the Harville formulas here. It turns out that we don't need to use the discounted Harvilles until we get to other bets, because there's a bias to win and a bias for second and third, and they essentially cancel as well. I will talk to you about that. So anyway, so let me go to the next page, please. This is just an experiment with betting over a period of time. That's all. Okay. So then I talk about Soros and Buffett bet as if they're Kelly. Can we go to the next page? And this is my favorite Renaissance medallion. Unbelievable hedge fund. I've studied them in several papers. They have a phenomenal record. They are the original fast traders in the U.S. stock market. Can I go to the next? This is just an endorsement by Ed Thorpe that PIMCO, many of you will know Bill Gross, who was the world's largest bond trader, who learned an awful lot from Thorpe. He was a big bond trader, and they're using Kelly in their investing. So I'll leave that to you. Can we go to the next slide, please? Conclusions. Let's just look at the conclusions. Number 1, the great superiority of full Kelly and close to full gratis strategies to other strategies over long horizons with very large gains most of the time. The short run performance of Kelly and high fractional Kelly is very risky. There is a consistent trade-off of growth versus security as a function of the bet size determined by the various strategies. No matter how favorable the investment opportunities or how long the finite horizon, a sequence of bad investments can lead to very poor final wealth with a loss of most of the investor's capital. And I'm now done, Kelly. Harry, I'm ready to go on to racing. If you want to put up other paper, and maybe after racing, we can take a whisker of a break. Okay.
Well, I think we'll probably have to at that point,
Yeah.
given the timing.
Good.
But yeah, so let's feel free to continue. Yeah.
Okay. Now, I wrote a paper. Some of you may know Thaler. He's a famous behavioral finance person who actually won the Nobel Prize in economics based on his behavioral finance work. Now, part of the things that he did to establish his credibility, sorry, I have this cough, was to do a sequence of articles on various anomalies in the Journal of Economics Perspectives. And this was in the late 80s. Now, he asked me to go in, sorry, and explain racing and lottery. So we wrote a paper, 1988, that's essentially the most quoted paper in the economics literature on racing. So that was 88. Now, in January of 2020, Thaler was asked to referee a paper by some guys at Microsoft and the University of Pennsylvania on various types of racing. And it was a good paper, and he didn't want to do it. So he recommended me to do it for the American Economic Review. And I did it. It was pretty good, but there were a lot of things they didn't know. So I got motivated to redo the Thaler Ziemba paper to up to date. So that's what this is supposed to do. So we argue that wagering markets have a better chance of being efficient because of the conditions, quick repeated feedback are those that usually facilitate learning. And also the bets have a fixed endpoint. Can I have the next page, please? Okay, now I'm not going to go through all this stuff here, but we talk about efficient markets. You can read it as you wish as well. A lot of markets are efficient. Actually, at the top, I show that the NFL football is efficient in terms of Las Vegas odds. But we did a book, Ziemba McLean, 2018, called the NFL Guidebook. And we show that we can win using mean reversion risk arbitrage strategies. So I know one of you is into sports betting. You might want to look at that book. And we're also doing another book at the moment, McLean and I, on sports betting, putting all our papers on baseball, basketball, highlight, racing, and NFL, and so forth. Can I go to the next page, please? Okay. In the next one, now at the bottom of the page, at a typical racetrack, the market accepts wagers for 20 or 30 minutes. These are at the track and also from simulcasts. Now, in the old days, 1990, you had different pools at different racetracks. So if you ran the Kentucky Derby and you bet in New Orleans, you got different odds than if you bet in Louisville. And Hosh and I wrote a couple papers about that, which are the reference ones here. Now all the money goes into the same pools. Okay. Can I go to the next page? Okay. Now, I argue that racetrack betting is an application of portfolio theory with well-defined endpoints. Now, I'm going to talk about professional syndicates. There are about 10 syndicates around the world who operate as hedge funds with gains approaching 1 billion over several years for the most successful. This includes Bill Banter in Hong Kong, the group in Sydney, Australia, which is now currently the largest. That group, I visited them 10 years ago, and they had 80 people working, and they were betting 1.2 billion per year, making 15% net, $180 million. The last I heard is they now have 300 people working and so forth. And the leader of that is called Jelko. And there are some other teams as well. Now, the game of the syndicates is, of course, to win. But the racetracks do not like syndicates who win too much money. So what the racetracks essentially force the syndicates to do is to break even on the bets. Make a zillion of these bets, huge amounts of turnover, and win the rebate. Now, what is the rebate? The rebate is from certain companies that take bets from various bettors. Like myself, I'm doing that. I'm a bettor, so I will do bets, and the bets are gone into the rebater, and the rebater, the track is charging, say, 15% commission. And by having a large number of these bettors aggregated, what they do is they give the track 5% instead of 15. They take 5% for their service, and they allow us bettors to get 5% cheaper commissions. So instead of paying 15, we pay 10. Now, what does this mean? That means that it's a little better for us. These people run a nice business. The tracks get a lot of money, but one thing that's happening, which is a slight negative, that the tracks have to deal with is that Joe Sixpack, who's going to Churchill Downs and betting his $50, thinks that he is facing a 15% advance, a take, but he's actually facing an 18% because the 15% is blended with the 5% for all the outside bettors. Okay, so the professional syndicates, their game is to break even, win the rebate. It's millions of dollars if you do it correct. Can I go to the next slide? Now, what kind of bets do we have at the racetrack? High probability, low payoff, like win, play, show. That's my original systems of my original systems I did with Don Hosh. And our books, if you're interested, it's called Beat the Racetrack. Thorpe did the forward for us. And they're a reprint house has reprinted them. They're on Amazon for a low price, hardback, very nice production too. Low probability, high payoff. Pick 3, pick 4, pick 5, pick 6. One horse is involved, win. 2 horses are involved, place and exacta. 3 horses, show and triactor. 4 horses, superfecta. 1, 2, 3, 4. In Hong Kong, they have 2 versions of the superfecta. They have 1, 2, 3, 4 exact and 1, 2, 3, 4 not exact. Double, 2 races. Pick 3, pick 4, pick 5, pick 6. Rainbow, I'm going to talk to you about in this lecture. Pick 6 is a very good bet, but it requires $2 tickets. And to have a good chance of winning, you have to bet $4,000 to $7,000. A lot of people don't have $4,000 to $7,000 to bet, so they bet on the favorites. So they'll bet race 1, they'll bet the best 2 horses. Race 2, the best 2 horses. So what happens to those people? They have a small chance of winning because more than likely they're not going to get all the winners. And if they win, they're going to get almost nothing because everybody else will have the ticket as well because they're all the favorites. So a rainbow was invented to replace the pick 6. And that one uses 10-cent tickets or 20-cent tickets. And those tickets allow you to, for $200 or $300, to have a lot of chances. But they changed the game. The first prize is the unique pick 6. And second prize is the ordinary pick 6, sharing the money. So what happens with the unique? It's almost always not unique because at 10 cents or 20 cents, people win it. So they have large carryovers and then they finally give the money away. And I'll show you that later. It's discussed later in this talk. Now, one concept that's important is the history of the races, of the horse's background. The idea of the so-called dosage theory, which is that some races require speed, some require stamina, some require both. And in the dosage index, you calculate the dosage index for a horse as follows. If they're very simple. And I think I've got one on the next page. Could you go to the next page? Okay, first of all, just go to the formula. The formula is the number of brilliant points. That's by having in your background, in your pedigree, in the 4 generations that we consider, all speed. So we determine horses called chefs, and the chef horses, generate speed all the time to their offspring. And the intermediate ones do that. Classic means speed and stamina. Solid means a lot of stamina, and professional is you can run all day. Now, can I go to the next page? Okay. Now, here's a horse which was called Athlete Alex. Alex won the Belmont Stakes in 2005. So here is his background. He has Northern Athlete is his sire. His dam is this one. Then the second run is a fleet, and so forth. And you see you have four generations. So what we do, can you go to the next page? Now I'm going to score up the dosage. The first generation, there was nothing. They were not chefs to race. And in the next generation, you have 4 points. So what you do in generation 1, you have 16 points. Generation 2, you have 16. They each have generation 16 points. And you split them up, and then you add up the totals. Okay. So for example, in the third generation is Mr. Prospector, who was a very, very famous horse. He was the horse that had the most speed of the great sires, and so forth. So you take his points there, and then you add up the points. Now, can I go back, Harry, two generations to the formula? One more back. Okay, so here's the formula. Now, what Steve Roman, my friend, who has a marvelous book on dosage, which he would not put in my series of books because for reasons we talked about it, and he just gives it away. But you can get his book on dosage. I talk about dosage and I use it as well. So what you find was that if you look at a lot of horses that run at the distance of the Kentucky Derby, which is 1.25 miles, they average about 2.5 dosage. Now, what about the Belmont? The Belmont is 1.5 miles. And those horses average about 2. So therefore, we create these arbitrary rules that if a horse has a dosage more than 4, which is too much speed, not enough stamina, he simply cannot win the Kentucky Derby. And the actual results were From 1929 to about 2000, no horse above 4 won the Kentucky Derby. So we had in the 80s a very good situation. We could calculate the dosage. If the horse is above 4, throw it out. It's not going to win. And we were able to basically get the winner of the Kentucky Derby almost every year. Some years you had 3 horses that qualified, and they would come in 1, 2, 3. So that was a very good thing. However, what happens with almost all of these anomalies is that over time, something kind of messes it up. So in the case of horse racing, the breed was pushed more towards speed in America. And then what happened was horses with dosages above 4 could actually win. And that's what's happened recently. It's much more difficult to bet on the Kentucky Derby now. Can I go to the next page? Okay, next page. The rainbow. I don't know how our time is going. It's 3:12.
I'd say if you could
Speed it up.
talk for 10 more minutes or so at most, and then that maybe a little less than 10 minutes, and then we can open up for questions.
Yeah, okay. Let me do rainbow and then try to do the optimization. Rainbow is on the next few pages. That is a bet where it's 10 or 20 cents. The winner of the jackpot is the unique winner, and the second prize is the ordinary pick 6. This is very popular right now. And if you go a couple pages over, Harry, what I do is I talk about how I would bet on this. And the best time to play this is on the day where they give away mandatory payout. Okay, every so often they do mandatory payout of all the carryovers, and then it's an ordinary pick 6. And I talk in here about strategies to play this. And then I will go to the next subject in my 10 minutes here. Can I go next slides? Can I tell you one that I should have won? This was a pick 6, an ordinary pick 6. There were 3 races with standouts. You see them on the bottom of the page. And there were 3 races with very hard to figure out in the Breeders' Cup. Well, one strategy you could do, which I thought about for quite a while, but I did not actually do it, is to single the 3 standouts and bet all the horses in the other 3 races. This costs about $2,000 to do it. So it was a pretty good strategy to do because it paid $2 million. So I'll leave it there. Can you go to the next one? And so forth. I'm going to skip pool guarantees, but just tell you what it is. A fellow in Dallas, Texas, is the world's greatest bridge player, and he, in fact, runs a business in sports insurance. And he hired another fellow and I to guarantee the Breeders' Cup right after September 11. And we did it by creating large tickets, so forth. The way it works is he guarantees a certain prize. If the people don't bet enough, we bet into the pool in such a way that we want to get our money back, and so that he does the insurance and gets his money back as well. And we did it in a couple cases. You can see the description here. Harry, the next part is the actual optimization. Maybe it's time to take a break. But
Yeah, well, it's probably time to wrap up and let people ask questions, since we're up against the time limit here.
You're already done everything.
Well, we have about we go for about 2 hours usually. I mean, we could see what people have to say, but I think it's a good time to let the audience speak.
We can do questions, and actually things took a little longer than I had hoped. The next part of this here is how do you create the optimal bets using Kelly. But maybe we can see if there are questions, and then I can respond to them.
Sure. Anybody with any questions, feel free to jump in.
Let me do this in a few minutes. Okay. First of all, we can go to the next page. I'm going to show you the graph here. Carrie, could you go to the next page? Okay, look at this graph. This is the graph of Apple from 1980 to 2000, the end of 2019. And if you go to current, it's somewhat similar. Notice that it's a huge gain, and it is a lot of jagged though. Now, I have some personal thing in here. When my daughter was in high school in Vancouver, in Crofton, a girls' school, I was consulting for Frank Russell Pension Fund, and I was making $9,600 a month for 6 days to work on interesting papers. And it was a lot of fun. And for her college, I would give her a check for $9,600, and she would buy Microsoft or Disney or Pixar or something for her college fund. Well, 2 of the checks she put into Apple. So 9,600 times 2 in the year 95 approximately. She was smart enough not to sell it throughout the whole period, and she had basically $3.5 million worth of Apple stock, or 4 million, somewhere in that range. So it's an amazing run if you did nothing. You bought the stock, it went up and down. So then my question that I pose in this paper, I know that you make out like crazy by holding it a long period of time. My daughter held Microsoft a lot of time. It's not as good as Apple, and some of the others, and so forth. So holding good stocks for long periods of time can be really good. So then I was going to figure out a way to beat that if I could. Okay, so if I go here, I'm going to go quickly because it's late for all of you people. So can I go to the next one? Next one. Next one. Now, keep going. Keep going. Okay, now what these pages are that Harry's just gone past, in the year 2012, we found that Apple was going up like crazy and peaked at 708. And we applied a mean changing model that I did with 2 Russian colleagues. Basically my idea, but they helped with the math. And we found that we exited at around 690. And the paper is in Great Investment Ideas. And we found that in the next year, Apple fell to 380 from 700. So that's that paper. Can you go back a couple pages and then forward again? Keep going back. Okay, now, I argued to you earlier that mean estimates are really important. So here I've got some stuff here on that. So can I go forward? Because I'd like to show you one interesting thing. Keep going forward, please. Okay, now this was, go back. If you look at this picture, these were 2012, and the dots, you see there's a lot of dots and one square. The dots are potential places where you could invest. So you bought then, you bought then, you bought then, and it keeps rising, it keeps rising. And when does the model tell you to get out? Okay, so we have this Russian stopping rule model based on means. When the mean changes from going up to going down, you exit. So the way it is you climb up a path at a certain rate, you're at the top, and then you come down, etc. So that was the picture there. So now what I want to do is go and show you for COVID what we had. So if you go forward, Harry. Okay, keep going forward. Keep going forward. This is, read this if you're interested, primer on the math, of how the math works. Continue forward. Keep going forward. A little more in the math. Now, here's the COVID period. Can I help you?
You finished?
Not yet.
Not yet. Oh, I finished 3:30.
Now, let's go to the next page. Okay, so here's some Apple and the S&P. So the way this model works, when you have a blue, it means go long. And then when you go up to a point where you exit, and then you go short. And then you go long. So I don't know if it means here. So here's the first picture. This is Apple going long and exiting. And this is Apple going short in the bad period around February, March, April. And then this is Apple going up to now. Okay? So that was fine. And then the bottom one is the S&P 500. And the same thing. You enter with the blues, you exit with the reds, you go short there in the bad period, and then go long. So the question is, did it work? And the answer is, yes, it worked. And I've got the results here of how much you would gain versus buy and hold in that period. So I really like this paper, and hopefully I'll get it published as well. Harry, I'm done this paper. I'm going to go back to the thing. If you want to hear about optimization in racing, we can continue there for a couple minutes, or we can quit. You can decide.
See, I think, I mean, while we're here, I'm happy to listen.
Okay.
So
why don't we do that, Harry? So next, importance of mean, we can skip. We know how to do that, right? Favorite long shot bias. Favorites are under bet. Long shots are over bet. Let's go to the next. After that. Now, look at this curve, these curves. These are the curves of track payback, less breakage, okay, for horse racing. In the left one, the top graph is the 1986 graph. And in that graph, you could gain by betting on every horse that's the extreme favorite, 3 to 10 or less. But over time, the curve changed. Notice that the long shots on the right are still have way low expected value, and you want to short them. But the favorites are not as good there. Okay, so that was, if you look at the left side of this graph, that's lower. And then on the right, this is by some Australian a friend of ours, Snowberg and Walken, who did a paper in my book and also published in the journal, and they have similar curves. Okay, why does the favorite long shot bias occur? There have been all sorts of studies of that as well, and Thaler and Ziemba talk about it, and as do others. Can I go to the next page? So forth. Then I want to show you, and here's a whole bunch of literature on favorite long shot bias. Now, the system we did, go to the next page, please. You remember this formula we did? This is the formula for place and show optimization. If you had some magical way of inputting the data electronically in 5 or 10 seconds and then computing, you could do this. But what Hosh and I did, if you go to the next page, I wanted to have an approximation for the expected value. And Don and I ran hundreds of races, and we calculated the expected values, and then we ran a regression, and we got this. The expected value to place is 0.319 plus 0.559 times WI over W, PI over P. So what is that? WI over W is the fraction bet on the horse to win, and PI over P is the fraction to place. So when the fraction to place is low, this is high. So in terms of practical case, and we discuss this in our books, you simply look at those 4 numbers and you can determine how to bet. You can use a calculator, or you can do it by approximation. And then continue on, Harry. Here's an example. Sonny's Halo, running in the Kentucky Derby. About 1/4 of the money is for win. 1/6 of the money is for show. So the expected value per dollar bet was 114. The optimal Kelly bet is 52 per 1,000. Horse won the race, paid $4 to show. It was easy to make these bets in the old days, because when you go to the Kentucky Derby and there's 15 seconds to go to the race, no one is at the window so you can bet. They're all watching TV. Okay, now I'm going to talk a little bit about pricing wagers and then maybe wrap it up for you. Harry, can I go to the next chapter? Okay, now this is a bet that you want to do place and show, place pick all at Santa Anita. And this is the probability that a horse comes first or second. Discounted Harville, and then you can calculate the probability that a given ticket wins, and then you can optimize. Okay. Okay. Next page. Now, here is just a formulation of a exacta bet. Exacta is horse I in the first race, J in the second one. You do the optimization here, and you just write out the formula, okay? And then you do it. Next one. So forth. So the idea, Harry, is for every type of bet, write out the formula of how it works, do the expected log, and then optimize, okay? So it's pretty simple, okay? So that's sort of what we do in all these bets. And we have computer codes to do these bets, in terms of the way we do it, et cetera. Okay, so then the ticket approach, can you go back to the last page? The ticket approach is a little bit different. What you do is you have 1s, 2s, and 3s, and you have so many in each category over so many races. Okay, so then what you do is you create this kind of large ticket with the combinations. The difference here is you have equal bets on all the same combinations. So you have score 6, which is all 1s. Score 8, which is a 2 and a 2 and 4 1s. And so you get the idea. I'm sorry, unfortunately, my cold is bothering me. I have to take a cough drop here. Sorry, Harry, could you just go on and I'll, okay. This was an interesting example. On September 11, 2011, the 10th anniversary of the attack on New York and Washington, the first 3 races at Belmont had winners 9-1-1. So the newspapers said that the chance of that occurring was 1,000 or 1,000,000 to 1. Anyway, what I did on this page is I calculated exactly by the formulas, and I get that it's 1 in 28, not 1,000,000 to 1. Now, if you go to the next page, here's a multiple ticket approach that we did. There's 6 races, 3 to 8. The payoff were 360, 460, 12, 9, 18, and 7. There was a pick 6 paid 86,347. The parlay, if you multiply the races together, was 15,000. We bet $1,922. We got a rebate of $154. And we collected 1 pick 6 ticket, 86,000. 11 5 of sixes, which was 692. So we collected in total 93,000. Now the question is, how did we do it? It's not easy to win the pick six, but we did it. The reason we were able to do it was we had a score 9 ticket. So if the score is 9 or less, we can win. So what happened? The box is the winner. So in race 1, we have a 1. Then we have another 1. Then we have a 2. And then we have a 2. And we have a 2. And we have a 1. So we have 3 1s and 3 2s adds to 9. So the key for winning was to win race 7. And in race 7, Love at Noon, the 2 horse, was 3 to 5. And Filigree was 4 to 1 in the morning line. Go to the next page. This is hard to read, but Love at Noon went off at 1 to 5 in that race. So everybody was lined up on 1 to 5. We put Love at Noon as a 1, but we put Filigree as a 2, and Filigree went off at like, it's in here, I think it's 18 to 1 or some large amount. But if you look at the final times in the previous races, Love at Noon, the fastest races he did, these are the final numbers at the top, are the fastest of the previous races. And Filigree could run faster than some of the Love at Noon races. So that was the key that allowed us to win the bet. Now, Harry, maybe what I'll do is stop now and talk to you for a couple minutes and then wrap up because we're late for everyone. Thank you for having me. It's always good to do this stuff. I hope your people enjoyed it a bit.
Well, I enjoyed it, and I appreciate all the time and the different topics. And so I just wanted to thank you and thanks again for coming, and thanks to everyone for being here. I'll stop the recording, but we can continue to talk afterwards.
Yeah.